Hello everyone and welcome back to my video blog. Today I'm going to share with you a topic that many of you have asked me over the last 12 months. And this topic is regarding the primary residence homeowner exclusion. Okay, what does it mean? It means that, if you have lived in your primary residence for 2 out of the last 5 years, you are qualified for a exclusion on the gain on the property. So let's say that you purchased your home back in 2020, and now you are thinking about selling it. Okay, so you have met the requirement of a 2-year residence, right? Okay, you have lived that one for 3 years already, so you qualify. And for a single person, it's 250,000. And for a married couple or a joint tenant, a domestic partner or even partners that have a share on that one, the maximum is $500,000. Okay, so yeah, and you have to have lived 2 of the last 5 years. But the IRS doesn't count just on the number of months or year; they are exact. They count on number of days. You have to live in that property for 730 days. Okay, 365 days a year times 2, 730. And many of you have asked me that question because you haven't lived in your house for the 2 years. And then what about how the tax will be calculated? Okay, so for example, you have only lived in that house for 18 months and you have to sell it for one reason or the other. I'm going to talk about the reasons. Okay, and how about those days? And then it will be prorated. Okay, so for example, by the time you close escrow, you have lived in that house for 100, let's say 420 days. Okay, so 420 days divided by the denominator, which is 730. So that's a fraction. That's give you the ratio, how much you can claim as exclusion from the 500,000 if you are a joint tenant, or as a single person, 250,000. Okay, so that's the number 2 thing, is a proration of the calculation if you have not lived in that property for the full 2 years. 730 days. Okay, and what is the exclusion that allows you to do that? You cannot just sell it because I find something else and do it. Okay, you can do it if you don't meet the 730 days with some exemption. The exemption first is, of course, employment. Okay, so if you get a new job, your job move 50 miles or more from your current home, you are qualified. That is one thing you qualify. For example, you got a new job, or you get unemployed and you have to move 50 miles, you are qualified. Okay, and then some unforeseen circumstances, for example, divorce, for example, and then let's say that your family suddenly get 3 more kids, adoption or triplets coming up, and you need to find a 5-bedroom that you cannot find here, and then you can find 50 miles away, you can move it. Or you have some older parents that you have to move to be closer to them to take care of them, and they are more than 50 miles away, you are qualified. So those unforeseen circumstances, they are totally kosher, and you use the ratio that I just mentioned to you with 730 as the denominator over the number of days that you have lived in your current home, you qualify. Okay, so the 2 things. Okay, so however, some people ask me about renting their primary residence. They found a new home that they like, but they don't want to sell their current home. But then they like to keep the $500,000 or $250,000 tax-free gain, right? So how to calculate it? So for example, you have purchased the home in 2020, and you have lived until now. Let's say today is September 1st, 2023. You totally qualify to have the full deduction, the exclusion, not deduction, exclusion, right? But you don't like to rent it out. So how you calculate it? So what you calculated is the 2 years from today before, right? So you do a minus. So 2023 minus 2 is 2021. So pretty much around September 1st or August 31st of 2021 until now, September 1st, that's your 2 years. So 2021, to calculate, plus 5 years, see 2026, right? Okay. So, and you have to sell your home by August 31st of 2026. Not to put on market, has to close escrow, everything done, deed recorded by August 31st, 2026. That's the number 3 thing. Those date has been very important, 730 days. I didn't make a calculation of number date, but just remember 2021 plus 5 years, 2026. That's the deadline that the transaction has to close. And how about say I like to keep the property and at the same time receive the $500,000 of the tax-free gain. Okay, that's one thing that you're gonna check with your accountant that this is done and is totally kosher. Is you sell your primary residence to a corporation that is under you. Okay, you are one of either the member or the shareholder of member is an LLC or a shareholder is a corporation. Okay, you ask your accountant which form of ownership is the best, LLC, a corporation, leave it up to them, okay, or your tax attorney. However, that's how you can do it, is you sell your primary residence to an LLC or corporation. So when you sell it, you claim the 500,000 and you still keep this property as a rental because you like it, sentimental value, and also probably investment wise is good investment. Okay, so after you sell that property become a pure rental, and then in future you can do a 1031 exchange. However, you get the best of both worlds, that which your desire is to get the homeowner exclusion, the $500,000 or $250,000, at the same time to keep the property. Okay, so a lot of people have a dilemma. So if I keep the property over 5 years, over the 5 years period, your homeowner exclusion is totally, wasted. Okay. However, if you take this particular step to do it, you can take the exclusion and keep the property. So I love to receive a feedback from you from this particular topic, and especially from the last step I mentioned regarding the transfer to a corporation and LLC. I welcome your feedback. You know where to get me. Text me, call me, email me. Love to hear from you.